8 times a year, a group of people sit around a table in Washington and make a decision that ripples through every mortgage, every savings account, every credit card, and every stock portfolio in America. Most people hear the headlines: Fed raises rates, Fed holds steady, Fed signals cuts, and move on without understanding what it actually means for them. By the end of this video, you will. Let's get into it. The Federal Reserve, or the Fed, is America's central bank. It was created in 1913, and today it operates through 12 regional banks across the country. Its core mission has two parts: keep inflation low and stable, and keep unemployment low. These are sometimes called the Fed's dual mandate. To achieve this, the Fed's most powerful tool is interest rates, specifically something called the federal funds rate. The federal funds rate is the interest rate that banks charge each other for overnight loans. Banks are required to hold a certain amount of cash in reserve. Sometimes one bank has more than it needs, another bank has less. They lend to each other overnight to balance things out, and the rate they charge for that is the Fed funds rate. Think of it as the wholesale price of money. Banks borrow at that rate, then lend to you, the consumer, at a slightly higher rate to make a profit. So when the Fed changes its target rate, it sets off a chain reaction. The Fed moves down, the banks adjust what they charge each other. Your mortgage rate, your credit card rate, and your savings rate all shift in response. It is the master dial that controls the cost of money across the entire economy. When the Fed raises rates, borrowing money gets more expensive across the board. For mortgages, this is significant. A 1% rise in rates on a $400,000 mortgage adds roughly $250 to your monthly payment. That is $3,000 a year, just from a single rate move. For credit cards, most variable rate cards are tied directly to the Fed. When rates go up, your minimum payments go up with them. Carrying a balance becomes increasingly costly. On the positive side, savings accounts start paying more. High-yield savings accounts and money market funds become genuinely attractive places to park cash. And for the stock market, higher borrowing costs squeeze company profit margins. Investors typically price this in by selling, which is why markets often dip when the Fed raises rates aggressively. When the Fed cuts rates, the picture flips. Mortgages become more affordable. Home buyers can borrow more for the same monthly payment, and existing homeowners with high-rate mortgages often rush to refinance. Credit card rates ease, making variable-rate debt cheaper to carry, though the smart move is still to pay it down as fast as possible. The downside: savings rates drop. The high-yield savings account that was paying 5% might drop to 3% or lower. Cash sitting idle slowly loses its purchasing power to inflation. And the stock market, it tends to rally. Cheaper borrowing boosts company earnings, and investors bid up stocks in anticipation of stronger growth ahead. Now here is the key relationship that ties everything together: the Fed and inflation. The Fed targets about 2% annual inflation, not 0. A little inflation is actually healthy because it encourages people to spend and invest rather than just sitting on cash. When inflation runs too hot, say 7 or 8%, like we saw in 2022, people are spending too much and prices are rising too fast. The Fed responds by raising rates. Borrowing gets expensive. People spend less, demand cools, prices stabilize. When the economy is too weak, unemployment is high, people aren't spending. The Fed cuts rates. Borrowing gets cheap. People and businesses take on loans, invest, hire, and spend. The economy picks back up. It is a constant balancing act. The Fed is essentially trying to keep the economy running at the right temperature. Not too hot, not too cold. Let's make this practical. Here is how to position yourself in any rate environment. When rates are rising, if you have a variable rate mortgage or are shopping for a home, consider locking in a fixed rate before rates climb further. If you carry credit card debt, attack it aggressively. The cost is going up. And move idle cash into high-yield savings accounts or short-term CDs while the rates are good. When rates are falling, if you have a mortgage, look into refinancing. Cash in savings starts earning less, so consider putting it to work in a diversified portfolio. And historically, falling rates have been a tailwind for stocks, though never make investment decisions purely based on rate direction. For bonds, it is worth knowing, rising rates push bond prices down and falling rates push them up. So if you hold bonds or bond funds, the rate environment matters. Let's land the plane. 1. The Fed controls the cost of borrowing. By setting the federal funds rate, it influences every loan, mortgage, credit card, and savings rate in the country. 2. Rates and inflation are deeply connected. The Fed raises rates to cool inflation and cuts them to stimulate a sluggish economy. Understanding that relationship helps you anticipate what is coming. 3. Rising rates reward savers and hurt borrowers. When rates go up, move cash to high-yield accounts and consider locking in fixed rates on loans. 4. Long-term investors stay the course. Rate cycles come and go. Historically, they last between 1 and 3 years. Trying to time the market around Fed decisions rarely works. Consistency wins. Now you speak the Fed's language. Next time they make a move, whether it is a rate hike, a cut, or a hold, you'll know exactly what it means for your mortgage, your savings, your credit cards, and your investments. Here is your homework. Check your savings account rate right now. Look at the rate on any debt you are carrying and ask yourself honestly, am I positioned well for the current rate environment? If this video was useful, please hit like and subscribe. New finance videos every Monday, Wednesday, and Friday. Next Monday, we're diving into index funds. What they are, why the world's greatest investors recommend them, and how to get started with as little as $1. See you then.